Okay, hello everybody. I'm Tucker Balch, and we're going to start the second webinar in our series of 3. Today we're going to focus on backtesting. Now, if you recall, in our last webinar, we showed you how we found appropriate data to generate this example strategy. The orange here is the performance of the strategy itself, and the blue there is a benchmark. And last time we got as far as showing how we selected the data and figured out how to match different data sets together. Today we'll talk about once we've selected that data, how can we backtest it. And we are Lucena Research. We're located in Atlanta, and we've got a number of products that we offer. Our flagship product is QuantDesk, and actually I'm going to show you some screenshots of QuantDesk today. It's a cloud-based predictive analytics tool that's integrated with lots of different data sources. I wanted to mention that QuantDesk is available on the Bloomberg terminal. We also license portfolio or model portfolios, and we do custom strategy development. Now, as I mentioned, I'm Tucker Balch. I'm a professor at Georgia Tech. I'm also chief scientist here at Lucena, and I'm joined here today with 2 of our quants, Taylor Korf and Richard Brooks.
How you doing, this is Taylor?
Hi, this is Richard.
All right. Okay, so as I mentioned, we're going through a 3-part series. Last time we talked about initial research and data. Today is backtesting, and in 2 weeks we'll have our final session, which is how we go from once we've got a successful backtest and what looks like a good strategy, how we carry that forward to real deployment. Okay, so today we're going to talk about backtesting. These are the topics I'm going to cover. First is, what is backtesting? Not everybody knows that, and we'll talk about that. There are some pitfalls when you're backtesting that quants sometimes fall into, and I'm going to talk about a couple of those and ways that we avoid those problems. We're going to recap a little bit about the data that we had settled on last time, and then show you how to backtest with QuantDesk, and then we'll have some open Q&A session at the end. So if you Google the word backtesting, you'll see something like this. Backtesting is the process of testing a trading strategy on relevant historical data. So what that means is you take your logic for trading, you roll back time to some historical point, and then you allow it to trade with the information it would have known back then. So backtests are simulations, and what they enable you to do is sort of check the robustness of your idea. Now, there are some pitfalls. One quote I like to mention, a well-known finance professional commented, "I've never seen a bad backtest." And what that means is lots of people are out churning away testing strategies and so on, and they don't often come forward and show you the ones that turned out terribly. They show the ones that turned out great. Of course, that's one way that we weed out. If it doesn't work in a backtest, it's certainly not going to work in real life. So backtests enable us to weed out lots of bad strategies. But if you see a backtest, someone is showing you the strategy that they've developed and backtested it, there are a couple questions you should ask them about that backtest. And it points to 2 things you need to be very careful about as you're developing a strategy. First is survivor bias data. If you use survivor bias data, you can have problems. Specifically, your strategy might appear to perform better than it really would have, and we'll talk about that next. Another potential pitfall is in-sample backtesting, and we'll talk about both of those potential problems today. If you want to know more about these things, there's a blog online. If you search for mistakes quants make that cause backtests to lie, I think there's also a video online about that too if you're interested. Okay, so let's talk about survivor bias data. Suppose we are in 2012 and we're developing a strategy. And this, by the way, this is a slide from an earlier lecture when we didn't have Jessica Lee to do beautiful graphics for us. So I hope you'll bear with the hand-drawn result here. Anyways, the universe of stocks that we're using in 2012 might be the members of the S&P 500 that were in the S&P 500 in 2012. Now you can see as we go through the downturn in 2008 and 2009, because we're using the members of the S&P 500 as of that date, we know they all survived that downturn. But in reality, many companies were delisted during that time period. And if you're only using the members of the S&P 500 as of a later date, you're biased towards stocks that have survived. Now, in reality, if we look at all of the stocks that were in the S&P 500 starting in 2008 and go forward, yeah, sure, some of them survived, but a number of them crashed and burned. And if you don't account for those in your backtesting, you're going to be biased to the upside. So you need to have access to data that includes all stocks that were available in that time you were backtesting, even the ones that didn't do so well. And let me show you the consequences. Here is a backtest using an identical strategy, and essentially all that it's doing is equally allocating to all members of the S&P 500. The green is if we use the members of the S&P 500 as of the end date. The purple is if we had used the ones that were actually in the S&P 500 at the time. And you can see we gradually see these two grow apart, and this is the difference. So it's about over this time period about 13% improvement in the strategy just because you're using biased data. Now all the research we do here at Lucena uses bias-free data, so we make sure that we're looking at all the stocks that existed historically. Okay, next thing I want to talk about is in-sample and out-of-sample. Now this is a nice backtest. Again, the performance of the strategy we're looking at is here in orange, and a benchmark is in blue. Now it's reasonable to ask, if you see a nice performance like this, which part of that is out of sample? And let's talk about what that means. So we usually choose a portion of our data to refine our strategy on. And in this case, the strategy we're showing you today, the time period we used was 2010. So we iterated, we applied machine learning and a few other techniques to find the best performance we could in 2010. Then once we established those parameters, we went forward and tested it forward, having made the decision about which data we were going to use and thresholds and so on. We then went forward into this time period indicated in the green, and that's the out of sample. Now sometimes people will do back tests where the entire time frame is in sample, and that kind of approach is guaranteed to provide exceptional results. It's only when you see a in-sample training period and a separate out-of-sample period that you can have some confidence that the strategy is going to work. Even then, you have to do some additional processes to make sure it's going to go well. And that's what we're going to talk about in the next session, refining and deploying. Okay, let me pause for a second and see if we have any questions. Nope, no questions? All right. I did want to let you all know, please do ask questions, and as we go forward, we'll take a break every now and then to take your questions. Now, I want to recap a little bit what we talked about last time. We looked at a particular data source, in this case, Dorsey Wright, and we selected two of their indicators that showed promise. In particular, Dorsey Wright's point and figure change days. What that means is how long has it been since it changed, and then the signal indicator, which is which way, is it a buy or sell indication. We used our one of our machine learning techniques, we call it Cadane, to discover which other factors, if we combined them with those, would give us even better performance. And we discovered two fundamentals that, when combined with the technicals from Dorsey Wright, gave us even better performance. Let me show you what I mean by that. This is the performance. Again, this strategy is in orange. This is the performance if we use only the technicals. Now that's strong performance over this time period. We're seeing a total return of 586% and a Sharpe ratio of about 0.8. Now, this is not using any fundamentals. It's only using the technicals. Now we can ask the question, well, what if you only use the fundamentals and not the technicals? Let me show you that. So nice performance here as well, return of about 530%. One thing to observe is during this period, the fundamental only strategy wasn't excelling as much as it was post-recession. But what if we combine them? And that's sort of the magic of the processes we have at Lucena, is we're able to search across hundreds of data sources. In particular, we have in our database about 650 indicators for every stock, and we apply our machine learning algorithms to find which indicators work best with which others. And if we combine these technicals and fundamentals into one strategy, we get even better performance. Here we're seeing a 726% return over this period, Sharpe ratio now above 1, great information ratio 0.95. So this is just showing how we're able to use machine learning to really eke out the best data items that work together. Okay, so we've selected our data and we've decided what thresholds we're going to use on those factors. That was the event study stuff that we talked about last time. Now I'm going to show you how we can turn that into a backtest. Have we got any questions?
Ryan wants to know, what machine learning algorithm do you find gives the best performance to security selection?
So there's a couple of things that we have to do in terms of our algorithms since we have such a large number of features, and how we kind of what our desired result is. And for a lot of these signals, our desired results are events, right? And so these events can be considered as a classification problem. And so on a high level for machine learning, we're usually implementing a classification type of algorithm. And classification is usually trying to delineate whether or not something is good or bad. And so it is you're putting things into bins, right? And so we're trying to figure out, for this stock, for this date, given the environment that it's in, is this a good buy or is this a bad buy? And Lucena develops some proprietary machine learning algorithms that are able to find appropriate features and appropriate ranges of these features to work in concert together to provide the performance that you're seeing in these strategies.
That was Richard. I'll follow up on that just to say that we've used a couple different techniques historically. One is a genetic algorithm approach. Another is called a forward-backward algorithm. And additionally, something we call Cadane. You can look up, Cadane's method on Wikipedia and find out more information about that. Cadane is what we use primarily to discover appropriate thresholds, and the other techniques help us distinguish which groups of features are going to work best together. Okay, now I want to show you what our platform looks like for backtesting. This is a screenshot here of QuantDesk. And QuantDesk is organized so that the major features are along the top here, and you can click on them to access them. And people usually start here in portfolios to look at their portfolio, but we're going to go over here to backtest. And this is what the backtest screen looks like when you want to backtest an event. So we have earlier decided which features we want to use, and that's those are indicated here, the features and the thresholds and so on. And we've investigated those using our event study approach. And now we're looking at creating a backtest. So for all of these modules, the configurations, the particular parameters you want to use are settable over here on the left. So we're going to focus in on this panel on the left. And actually, there's two different panels. There's some, if you're setting up a backtest, there's general parameters, which, and let me jump to that and show you. These are things like what do you want to name the backtest? How much cache do you want to start with? What date period are you going to backtest over? What benchmark do you want to use? We often use S&P 500, but you can enter a symbol for any other particular index or stock that you want to use. We often use mutual funds that represent particular universes that we're interested in. Another part of this panel, which is very important, allows you to set transaction costs. So when you roll back time and you simulate trading, there are a couple things that you need to model here that otherwise your performance might be, your backtest performance might be better than you would actually be able to realize. So first of all, you have to consider commissions. And we use numbers here that represent commissions at a discount broker, in particular interactive brokers. Another important one, though, is slippage. So, we have historical prices, what the stocks were trading at historically. But if you actually engage the market and participate, you're impacting it in some way. So we assume that each trade entering and exiting, in these particular examples, that we're seeing 5 basis points of slippage. So we look at whatever the price was historically, and when we penalize ourselves when we buy. So we assume we would have gotten a price 5 bips higher, and we also penalize ourselves when we sell. We deduct 5 bips from the selling price. So those are the general parameters. Now there's specific parameters to the kind of backtest you're going to do. In this case, we're doing an event backtest. Now, one thing to think about is, okay, we've defined an event, so an event is a set of features and a range of values that we're willing to accept. And if a stock on a particular date passes that event description, it's eligible to go into our portfolio. But we have to consider things like, what if our portfolio is already full, for instance? How do we configure things so that we can, how do we operationalize this into a real strategy that can be executed? So that's what a number of these factors are. So let me just step through these one by one. First of all, one thing you got to know is, okay, if the stock passes the screen, do we think it's going to go up or down? So we indicate here long or short. In this case, we think the stocks are going to go up, so we indicate long. Next is days to hold. So if a stock passes the test, how long are we going to hold it? You can select a number of days here if you like, or in this case, we've selected conditional. And what that means is if the stock passes the screen, we'll add it to our portfolio, and we'll continue to hold it until it no longer satisfies that screen. Now, let's suppose we had a large number of stocks passing that test on one day, and we can't add all of them to the portfolio at once. How are we going to rank them and choose which ones to use? So you select one of the factors here that you want to use for that ranking. A couple other parameters here. How many equities might you add per day? and on each day, what percent of your portfolio will you allocate to them? What's the minimum you would allocate to any equity, and what's the maximum? So a lot of different factors there, and you can, with QuantDesk, you can test different ones and see what sorts of different results you get, and we'll show you those in just a moment. In fact, right now I'm going to show you what QuantDesk looks like. This is you're seeing now a screenshot of QuantDesk. Let me make sure we're looking at the right screen. Yep, okay. So here are those two panels, the general panel and the event panel. And so let's say we've configured everything, and now we want to run that backtest. So Taylor, what's happening now?
So the first thing QuantDesk is going to go do is going to go assess what your universe is. So earlier on the slide, we could see that Tucker's event study here is assessing the S&P 500 and the Russell 1000 as his starting point. So QuantDesk in the background is going and it's fetching the daily constituencies. It's another kind of bias that people usually fall into. You want to make sure that you're assessing on each date what was actually in the S&P 500 or the Russell 1000, not what it is today. After that, we're going to go fetch survivor bias-free data for those constituencies, and then we'll apply the event study features to that. So if this event study we're scanning for PEs greater than 0.5, we're going to go apply that as a filter on top of that universe. That'll give us a list of securities per day, and then as Tucker was talking about, the logic max allocation per day, max and min allocation per asset, holding period, stop losses and stop gains. Those are all going to be assessed on a per day basis. And you're going to run through the entire duration of the backtest. And at the end, which we'll see here in a bit, you'll get to see a report. If you'll go ahead and click, yeah, you'll get to see a report like this that shows you how many things you were holding, the performance, Sharpe ratios, risk return, what kind of leverage you're looking at, or are you fully allocated, as Tucker was talking about, and also at the end you'll get a PDF printable and shareable report.
Yeah, so this after you run a backtest, this is the sort of display you get. The strategy you're testing is shown here in orange, and by the way, this is over the time period 2010 for that strategy we've been looking at. Here you see in green here on each particular day how many positions you were holding in the portfolio. In red here, it's telling you how many stocks satisfied your event screen on any particular day. So during this period, we're seeing about 80. Earlier here, up into the 200s and 300s, but our portfolio at any time is only holding about 40 positions. We show you a lot of typical statistics over here, like Sharpe ratio and return, correlation to various sectors. Down here along the bottom, you see what your exposure was. In this case, we're always long, but you can see it takes a little while to ramp up to full leverage here. Now we have very comprehensive and detailed reports. I'll show you what one of those looks like. And these are, as Taylor mentioned, printable by PDF. Actually, I was going to jump to one we already had, but it looks like this one's coming up fine. So again, you see that chart that we were looking at, typical statistics over here. Let me go to one that's a little bit longer. This shows you for each year your return on your strategy compared to the benchmark's return. And then we have, this is a fairly important chart here. It shows the relationship of your strategy in terms of risk return compared to the benchmark. And you want to be up and to the left here. Anyways, I won't go through all of the statistics you get back here, but suffice it to say that we report very comprehensively, including, for instance, turnover and so on. One thing to be sure to point out here is we do include transaction costs, and those are the settings. And here's the total accrued transaction costs over time. So in this particular simulation, we're seeing a total of about $660,000 in transaction costs over the period of this backtest. Okay, do we have any questions relating to any of this stuff?
So someone wants to know, how do you decide which symbols to buy that have passed the event screen?
Yeah, so one of the options for the event study backtest is to specify the maximum number of equities you can buy a day. So if you set that number to 5, but your screen is giving you 20 things, we also have the ability to rank your equities based on a feature. Now you can't see here, but that's actually a drop down where you can pick whether you want to rank by PE ratio or Sharpe ratio. Maybe you want to rank by liquidity. You can do that in ascending or descending order. So that's how we would pick from a large screen a set number of assets to buy per day.
Thank you, Taylor. Now, another, I don't know if anybody has asked this question, but I think a question that would be reasonable to ask is, how do you know which values for these particular factors make sense to use? And this is some of the work that Richard's been involved in. And Richard, maybe you can address that.
For the event scans, for figuring out which ranges to use is we go through a process where we will look at the event landscape, and when we will, I guess, classify whether or not we think future returns are good or bad, and then based on whether or not they are good or the bad, we will try to find out for each specific feature what contiguous range for that feature provides the highest probability of good events. And this is done algorithmically, and through this process that Tucker mentioned earlier called Cadane. And to make sure that it is reliable or robust, what we do is we provide this analysis through a cross-validation landscape. And what that means is we are, for some historical period, we were trying to figure out what features and then what ranges for those features are most predictive or most probable of providing good events. And then we will go and then we will evaluate that on a time frame that is after the training. So the idea is that we will do this on an iterative fashion, and then we will find out what works best in sample and then also in the evaluation time point, which is out of sample. And the strategy that works the best in and out of sample over a long enough period, we deem as appropriate enough to deploy a strategy for.
Okay, so after all that research and effort, we finally see performance in a backtest like this, and so we're very happy, by the way, with the value we see in these in the Dorsey Wright signals, and also we're real excited to have discovered that combining them with some fundamentals even improves that value further. Now, at this point, what we have is a successful backtest, and we're not really ready to deploy money against this strategy yet. There's a few more steps we need to take before doing that, and that's what part 3 is going to be about. In particular, just kind of giving you a little bit of advanced information there. When we find something that works really well in backtesting, our next step is to forward test it, and that means we freeze the model as it is, and then we essentially pretend trade it, we paper trade it going forward. So the model, we know for sure it has no way of seeing the future, and it's acting as if it is really trading. And if we see success there, then we consider deploying actual capital against it. Okay, so that is what we wanted to cover today, but I wanted now to take any questions folks might have.
So someone asked, is the holding period static, or can the system produce optimal holding periods for positions, or dynamic holding periods such as held until system generates a close signal?
Yeah, so one of the options Tucker was using was called a conditional hold. I believe he talked about it, but just to recap, basically it'll keep you in that position until the criteria for that security no longer passes. For the backtest, you're not stuck to holding for 5 days. You can pick whatever holding period you want. But as far as determining what an optimal hold period is, there's another module called the event analysis module on QuantDesk, where we have a lot of metrics that help you determine what the optimal hold period is. We'll probably talk about that in a future webinar. It's a little out of scope for today.
Philip wants to know how much data, period of time wise, do you usually need for backtesting?
We usually do around 7 years for validation, and then another 5 years for out of sample. So this is enough to kind of see how your strategy will behave both in your training period and in your out of sample evaluation period through various regimes and market recessions and so on.
We almost always make sure to evaluate through the recession, because everybody wants to know, how would the strategy I'm looking at have survived decently through that recession period. In this case, we're, because we're long only, we're seeing about the same drawdown as the market overall, but we certainly don't want to see worse performance there.
How about forward testing?
Oh, so ask that question again.
It was like, how much data do you usually need for backtesting? And then he wants to ask, how about forward testing?
So that's correct. That even if you're having out of sample evaluations, you still fall prey to multiple comparison biases, and so usually too, with the client that we have, if we do see something that's favorable even out of sample, we will usually forward trade it in live time and keep track of the portfolio on an ongoing basis for probably 3 months to see how the performance is, and if it deems consistent with historical results, then it's usually a good sign to deploy.
Okay, one more question.
Do you use a single ranking process or multiple ranking strategies to make buy or sell decisions? And is the decision for which ranking to use automated or human?
So it's a good question. So the process is automated to select which features to use, and then when we do ranking, we also use an automated process to see which ranking method works best. And of course, on QuantDesk, you can choose those manually and see what works best, or we can run a separate process here at Lucena to uncover that information. Okay, well, thanks everybody for joining us, and please join us for the third session, and that'll be in 2 weeks, where we talk about how we go forward from having a successful backtest to deploying and applying real money to a strategy. Thanks very much, and look forward to seeing you again soon. Bye-bye.